From the Cube studios in Palo Alto and Boston, bringing you data-driven insights from the Cube and ETR. This is Breaking Analysis with Dave Vellante.
This winter's 2026 hyperscale earnings prints from Meta, Microsoft, Alphabet, and Amazon made it unequivocally clear that CapEx is accelerating. Combined, these four firms will spend more than $615 billion in CapEx this year, an increase of approximately 70% over what was already considered an inflated 2025. Now, despite the strong fundamental AI and general purpose computing demand, this news caused significant concern for market watchers because the aggressive spending has murky payoffs. Combined with the Anthropic-infused SaaS attack, investors took stocks down for most of the week, including Nvidia. Confusingly, much of the CapEx spend is actually going to Nvidia. Perhaps as much as 60% of the AI portion of that CapEx will go to that company, a point investors seem to overlook. Notably, the market is bouncing back today. It's Friday, kind of midday, a little after 3 o'clock, so we'll see how it closes. But after earlier this week, got a total rout. And so in this breaking analysis, we're going to squint through the statements made by company managements on this week's earnings calls, including what we see as some assumptions that conflict with our scenario for how the AI build-out is actually going to evolve. In particular, while operators are understandably focused on NVIDIA's gross margin and what they have to pay NVIDIA, we believe observers are way underestimating the cost advantages that NVIDIA has relative to GPU alternatives, including those from AMD, Intel, and the hyperscalers. Okay, so let's bring up the first slide, if you would, Alex, and take a look at the CapEx story here. It's just astounding. Amazon announced last night, Thursday night after the close, a $200 billion CapEx. The stock is well off today. And Google, interestingly, right there as well. Meta earlier, I guess last week, same. Microsoft increased the percentage of its CapEx spend, but the Azure growth, as we reported last week, decelerated by 1 point, and actually it was 1 point off of what the street was expecting, and so there was a divergence between CapEx growth and Azure growth, and so they took that stock down. Everybody freaked out. Anyway, the point is, we're talking about $615 billion in CapEx spend this coming year. And as I say, most of that is going to go to cloud and AI. So, I mean, you think about that on top of around 300 and change last year, that is just amazing. So what I want to do now is I want to dig into the commentary of particularly, we covered Microsoft pretty in depth last week. And I want to dig into the commentary from Andy Jassy and AWS, as well as those comments from Sundar Pichai at Google. Let's bring up the AWS commentary first, Alex. So, kind of interesting, and I squint through this a little bit. So $142 billion run rate, that's 24% year-over-year growth, better than I thought. I had them at 21 or 22% growth, and so they exceeded that. Now, Jassy said on the call that they're adding more incremental revenue and than competitors. So I want to poke at that a little bit, because you really need to understand that in a little bit more detail. So let me share with you the exact quote. He said, as a reminder, it's very different having a 24% year-over-year growth on a $142 billion annualized run rate than to have a higher percentage growth on a meaningfully smaller base, which is the case with our competitors. It's actually not the case. It certainly is with some of the competitors, but I'll show you later on that, in fact, it's not the case with Azure. Bring that same slide back up, if you would, Alex. So the next point it was a really interesting point that Jassy was making. The data really needs to be in the cloud to use AI in an expansive way. He said, I'll give you the exact quote, and I think the other thing is that if you really want to use AI in an expansive way, you need your data in the cloud, and you need your applications in the cloud. Those are all big tailwinds. And the other thing that he mentioned, and they said there was a debate going on, and I agree with that, He says, to date, companies have tried to shape models with their own data late in the process, usually with fine-tuning or post-training. There's a debate in the industry about this. We believe the enterprise will want models trained on their own data in an early stage of pre-training, if possible. Now, this is something we've talked about on Breaking Analysis, and David and Floyer and I have reported on it. Initially, the narrative in the industry was get your data house in order, and then then go invest in AI. We found the opposite when we talked to the leaders implementing AI, and I think Jassy and AWS and Amazon are one of those leaders, as are companies like we mentioned, JPMC and Walmart and other tech companies. Dell, I think, is another really good example, IBM. What they found in many cases is that actually having the AI help shape and cleanse the data is the right approach. And it's okay if not all the data is clean. Alex, bring that same slide back up if you would. I want to carry on with some of the comments. This is really where I go on to get into the sort of heart of what we're talking about today. So Graviton and custom silicon, Jassy talked a lot about that. He said they got a $10 billion run rate business in silicon. I'll come back and talk about that a little bit. He talked about GPU leaders. He's talking about Nvidia. He didn't mention them by name in this context. He said they're not really motivated to deliver better price performance. And again, he closed on $200 billion of CapEx. Let me dig into the exact statements, if I could. He said, we're adding significant EC2 core computing capacity each day. And the majority of that new compute is using our custom CPU silicon Graviton. Graviton is up to 40% more price performance than leading x86 processors, and is used expansively by over 90% of AWS's top 1,000 customers. Impressive, right? And we've written a lot about Graviton. We talked about Graviton and Nitro being AWS's secret weapon, and they've leveraged that. We're in a new era now, though. Graviton itself is a multi-billion-dollar annualized run rate, growing at more than 50% per year. The reason I say that we're in a new era now is because Graviton was designed to compete with x86, and x86 was kind of flattening out in terms of its performance curve. We know Moore's law is dead. You hear that all the time. They have the jam cores in and use other tricks. And so it was much easier for Annapurna and Amazon. Annapurna is the company that AWS or Amazon purchased, the Israeli-based silicon design company that they were working with since probably 2014. So they had a nice lead on this. But at any rate, it was much easier for them to compete with the x86. Now, the other piece that I really object to, I think Jassy was, I would challenge him on this. He said, another challenge is cost. I've said this many times, but if we want AI to be used expansively as companies, we want to have the cost of inference to be lower. I agree with that. A significant impediment today is the cost of AI chips. Quote, customers are starving for better price performance, and typically, and understandably, the dominant early leaders, that's Nvidia, there's one dominant early leader, aren't in a hurry to make that happen. They have other priorities, which is why we built our own custom silicon and with Trainium, and that's really taken off. We've landed over 1.4 million Trainium 2 chips. Our fastest ramping launch ever. Trainium 2 is 30% to 40% more price performant than comparable GPUs, and is a multi-billion-dollar annualized revenue run rate. Anyway, but first of all, I would say that he's right in the sense that because AI demand is so huge and Nvidia can't service all that demand, that naturally Trainium is going to pick up some of the undersupply. Essentially, I've said this before. I said, this is brilliant. AWS is bringing the Graviton playbook to GPUs. The difference is they're now competing essentially with Nvidia. They're not competing with x86 anymore. And that's number one. Number two, I think it's nonsense that it's true that customers are starving for better price performance, and typically and understandably the dominant early leaders, Nvidia, isn't in a hurry to make that happen. That is nonsense. And he'll tell you why. Nvidia announced that at CES, 5x performance improvement, 10x throughput improvement this is with Vera Rubin, and a 1/10 the cost. So they're obviously improving price performance. So that was disingenuous by Jassy, and I think ignored the fact that that NVIDIA is definitely driving better price performance, but that's not the whole story. I'll come back to it because NVIDIA is on a way faster track than anybody else. And then, the point about CapEx on that previous slide. All right, Alex, bring up the next slide. Let's get into the Google commentary because there were some similar but different themes. He talked about a wide variety of compute options, including NVIDIA. And so this was kind of interesting because the fact that this is the multiple times Sundar Pichai has called out NVIDIA as a good partner. So this includes, quote, this includes GPUs from our partner NVIDIA, who announced at CES that we'll be among the first to offer the latest Vera Rubin GPU platform, plus our own TPUs that we've been developing for a decade. Here's what's going on here, folks, is everybody has to get Vera Rubin allocation or they are screwed. They're going to fall behind it. And all the insiders know this. They know that if they are not on allocation or getting allocation from NVIDIA, they are going to lose out to the competition. And so that's why Sundar and others are referencing NVIDIA, constantly. So bring that back up, if you would, Alex. So the other thing here that we talk about is you got to really be impressed with what Google's doing in the cloud. I'll back to that, but let's go to the right of this slide first. It said first, once people start using these new experiences, they use them more. In the US, we saw daily AI queries per user double since the launch, and AI overviews continue to perform very well. I use Gemini. In fact, I'm liking Gemini more than I am ChatGPT these days. I use them both. I use them all, but Gemini is my, recently my more go-to. It's pretty awesome. But here's the interesting quote. Queries in AI mode are 3x longer than traditional searches. We're also seeing sessions become more conversational with a significant portion of queries in AI mode now leading to a follow-up question. Third, people are searching in new ways beyond text. Nearly 1 in 6 AI mode queries are now non-text using voice or images. I'd say about half of mine are in that last category. So he's right. I mean, the demand for these queries is going to the roof, and Gemini is doing very well. The thing he doesn't mention is that search queries are they're fractions of pennies. AI queries are 100 times more expensive. So it's interesting. The Super Bowl ad that's coming up this weekend has that. If you've seen it, there's this geeky dude doing pull-ups, and he looks like the skinny Sam Altman. And he gets off the pull-up bar, and there's this buff dude, this guy who's obviously a great athlete. And the little nerdy dude goes, "Can I get a 6-pack?" And then basically it's Anthropic crapping all over OpenAI. And his response, the dude's response is, and he gives him some ad. He sticks some ad in the face, and the commercial basically is no ads on Anthropic. So this is pretty fascinating that you're seeing this. Now, I would say a couple things. One is, I have said, and we'll see if this pans out in my predictions post, I actually think at OpenAI's presence and ChatGPT's presence and volume in consumer is going to be an advantage, not a bug, to their business model. Not only their business model, but just their data model, number one. Number two, remember, during the Code Red in December, Sam Altman said, we're going to pull back on ads. I think this is less about monetization. I think it's more about the fact that they don't want to give Google a long runway to transition their business model to a model that's 100x more expensive. If they can put more pressure on Google and pull more business away from Google and ads, it will affect their ability to compete in the enterprise. Now, the risk to that scenario is Sam Altman's fighting wars on many fronts, right? I mean, he's got consumer, he's going after Anthropic in the enterprise, he's talking about doing silicon, on and on and on. But that's going to be really interesting to watch. Okay, Alex, bring that same slide back up if you would. And so bottom left, cloud revenues up 48% with GCP, and cloud operating income now 30%. This is pretty important. I'll read the quote. Google Cloud segment delivered outstanding results. I would agree in the fourth quarter. It blew away my expectation. I had them in the low 40s. They came in at the high 40s. The business continued to benefit from strong demand from enterprise AI products. And the cloud revenue accelerated 48% to $17.7 billion. That's in the quarter. Remember, Google doesn't report its GCP revenue. It reports its overall Google Cloud, which includes Workspace and all the other software. It's kind of like Microsoft doesn't report Azure revenues. They give little hints. They do growth rates. And so anyway, revenues were driven, this is Google Sundar, revenues were driven by strong performance in GCP, which continued to grow at a rate that was much higher than Google's overall cloud revenue growth rate. I mean, I think they grew over 50% in the quarter, and they're just not saying it. I think low 50s is where GCP is, and I think it's sustainable, and I'll share with you why. Well, the why is AI, duh. And then we had strong growth in both enterprise AI infrastructure driven by TPUs and GPUs, and talked about their operating margin increasing to 30.1%. It was 17.5% last year. I think it was in the low 20s last quarter. So pretty impressive performance by Google. Okay, this is data from ETR's proprietary survey of 1,746 accounts. That's the January survey. And the vertical axis is their net score methodology, which is a measure of spending momentum. And the horizontal axis is overlap within those 1,700 accounts. And we've plotted Azure, AWS, Google Cloud Platform, and Alibaba. Alibaba only had 34N, so you can kind of ignore that. The other three are above the 40% mark on the vertical axis, which is considered highly elevated. Azure in the upper right is phenomenal, 57% net score and 1,000 shared N. What's interesting is the progress that GCP is making. So you can see the little edits that I made there. Google account penetration, GCP versus AWS in January 2024 was 40% of AWS's N. In January 25, it's 56% of that N, and that's the calculation there is at 456 divided by the 819. GCP versus Azure, GCP versus AWS, AWS being the denominator. On the right-hand side of this, you see GCP versus Azure. It's making progress relative to Azure, just not as much. Now, Alex, if you go to the next slide, a big part of the reason is in machine learning and AI. The previous section or a sector was cloud. This is the machine learning AI sector back in January 2024. And you can see in the lower left, Google on the axis, by the way, they're all above 50%, which is impressive, but Google on the left axis, on the x-axis, behind AWS. Now, Alex, if you go to the next slide, you can see Google overtakes AWS on the x-axis, and they've got comparable net score, almost identical at 58%, Microsoft at 66% net score, and we're not even including OpenAI in this metric. So you can see the combination of Google's AI and machine learning chops and its strong data are catapulting it into not only a strong position within machine learning and AI, but it's also presenting a tailwind for their cloud, as we saw a couple of charts ago. So the point is, and the premise is, that Google's AI chops are allowing it to gain AI and data, allowing it to gain traction in the overall cloud business and the GCP business. And we can see that actually showing up in the market data. So let's go to the next slide, Alex, and you can see this is our IaaS and PaaS cloud market shares. This is revenue market shares. We shared this last week. We've had to update it. Now, a couple of points here. So this is updated for 2025. Alibaba and Oracle haven't reported yet, but so we'll update those, accordingly. And Azure's not on a they're on a fiscal year, they're on a calendar year. So this is calendar year. Now, what you can see is AWS in the quarter grew 24%. That'll get them to 129 billion this year. It's really astounding. Look at Azure. Okay, what Jassy said early on is not true. Remember, I shared with you, he said that 24% year-over-year growth on $142 billion annualized run rate business. It's different because they have a higher percentage. It's different to have a higher percentage growth on a meaningfully smaller base, which is the case with our competitors. He said, quote, "We continue to add more incremental revenue and capacity than others and extend our leadership position. It's not true that they added more incremental revenue than Microsoft, Azure. Azure, by my estimates, remember, they don't report Azure. These are my estimates, but I probably spend more time thinking about Azure than anybody, except maybe some people inside of AWS and in terms of the market numbers. People at Microsoft actually know what they are. But Azure added $23.9 billion last year over 2024. AWS added $21 billion. So what he said was not true. It's true for Google. It's true about Google, true about Alibaba, true about Oracle, true about everybody else on the planet. Not true about Azure. So I just wanted to sort of point that out and call that out, frankly, because I think, that's what we do here. We try to tell it like it is. Okay. I want to close with a couple of key points. I'm going to start with some clips that I pulled from the AI summit that Cisco held this week. In a sit-down with Matt Garman, Jeetu Patel, the president and chief product officer at Cisco, he asked some fabulous questions, and he was pushing Matt Garman on semiconductor cycles, like time to tape out. He didn't use that word tape out, but tape out being the time it takes from, shipping the design to TSM or whomever, the foundry, and getting to, a product that you can actually start testing and get yields up. So there's two clips that we're going to play. And Alex, feel free to just play them contiguously. The first one is going to talk about that cycle time of semiconductor tape out. Again, my words, he didn't use the word tape out, but that's what he meant. And the margin implication of doing your own silicon. So play the clips, then we'll come back and talk about it.
Do you see the economics of AWS changing where the margin structure gets even better? Because if every application has inference and you're going to have inference capability on in the stack that you have built out, does that improve your margins over time?
I have no idea. That's a good question. That's for the bankers to guess on. But I will say it definitely, I think it improves our margins versus only using Nvidia GPUs. And they're always going to be a big part of that, but necessarily a big part of that margin goes to Jensen and the team. And we love their products and they execute awesome. But when you have 70%, 80% gross margins, there's room in there for somebody to take less margin, have a higher performing part, and offer choice to customers. And so we think that we can offer better price performance for customers, choice for customers so they can pick between the various options out there, and have the richest set of capabilities that are unique to AWS that they can't get anywhere else. And that's part of why we've invested in silicon for the last 10 plus years now, and it's such a big part of what we deliver, which is that differentiated performance all the way down to the silicon layer, which together with our partners offers a really rich set of capabilities that people can build on. And I think Trainium for us is a huge part of that, whether it ultimately allows us to increase margin or keep margins where they are and lower prices for customers. Frankly, I'd probably bet on the second, because that's just how AWS operates.
Is wired,
and so my guess is it's probably more that, which we try to grow faster. And because we find that every time we lower prices, generally, we pass them on to customers, and it gives customers more budget to go build new workloads, and for us, that generally leads to a good flywheel.
So, you continue to make sure that you're building out the chips. What's the average cycle time of chips now that you have? Every 18 months you're getting a new version of the chip out?
18 to 24, it depends.
But that's compressing.
It sometimes is compressing, generally, but call it somewhere between 18 to 24 months.
Right.
But sometimes you're also limited on your process kind of generations.
Yes.
Okay. So G2 tried, as you heard, he tried to say, well, the cycles are compressed, right? Okay. And Garmin wouldn't take the bait, either because the cycles aren't compressed materially, or because he's just being conservative. But think about NVIDIA's cycles. In 1 year, they're talking about 5x performance improvement, 10x throughput improvement, 1/10 the cost of the previous generation. That's in a year. It's a 12-month cycle versus an 18 to 24-month cycle. And we'll see what kind of performance the next cycle from Amazon and Google TPUs and Microsoft with Maya and Cobalt and their silicon. They are not going to be able to keep up with Nvidia is the point. And so based on Garmin's chip lifecycle comments, that says to me that they're going to fall further and further behind. And again, the second point I would make is bringing the Graviton playbook to the GPU space is different. It's a whole different animal than Trainium competing with Nvidia. Now, Jassie's comments in red, again, are not true, and it's unfair to Nvidia. Customers are starving for better price performance, and typically and understandably, the dominant early leaders aren't in a hurry to make that happen. Nvidia just increased performance by what I shared with you, and cost decline 10x, and we think, by the way, with Jevons paradox, which G2 mentioned, I don't think got into the clip, is going to increase demand by 15x because of Jevons paradox. So also in the clip with Garmin, you heard he cited the challenges with getting supply from TSM. That's because Nvidia has it locked up. So that means they're going to fall further behind. And so volume is everything. So let's see, Amazon talked about a $10 billion run rate chip business. Nvidia's got a $225 billion run rate business. So at 20x the volume in 18 to 24 month life cycles, Amazon and the others are going to keep falling further behind. Now, what's the good news here is everyone's sold out. So demand far exceeds supply. So you can sell your Trainiums, you can sell your TPUs, you can sell your Mayas, and you can identify workloads where they're appropriate. And that's probably going to happen in perpetuity, maybe. But if Nvidia is going to be the dominant volume supplier, they are going to have a better cost structure. Now, what about the edge? Everyone's talking about the edge. So, AWS and others are going to get the parts of the workload that they can offload, no question about it. But inference is a different market. And, edge is a different market. Traditional clouds, they're too big and far away. So we're going to see lots of little cloudlets pop up all around the world with inference stacks that are going to be proximate to the customer and the customer's data. So where's that leave Nvidia? Well, you may have said, well, Nvidia's too expensive, or they're not going to be able to compete at the edge. That all went away, in my view, with the Groq deal that they did. Groq is all about, Groq with a Q, all about edge. And Nvidia, locked up that relationship. So that is going to be a key strategic deal. We'll see. I think Nvidia, in our modeling shows, they're going to do very well at the edge. Now, does that mean that the hyperscalers are going to cancel their silicon projects? No. Is it going to erode NVIDIA's moat? Are they going to erode NVIDIA's moat? No, they're not. I think TPUs probably have the best leg to stand on. Amazon's so broad. There's got so many use cases. They even said, Matt Garman even said, we rarely retire an EC2 instance. But either these guys know that, which is why, know that NVIDIA's got this huge lead, which is why, they, give homage to Jensen, or they've got a blind spot. And I don't know if they have a blind spot. I hope they don't. But it could be like back in the OS2 days. Many of you don't ever heard of OS2. Back in the day, IBM and Microsoft had a deal. And they kind of had this situation where IBM was making OS2 as a competitor to Windows, and to negotiate and settle, IBM basically said, we'll take OS2, which was their proprietary PC operating system, and Microsoft said, okay, we'll take Windows. Well, I have to tell you who won. And so hopefully this is not an OS2 moment for the hyperscalers. Okay, that's it for now. Thanks to Alex Meyerson, who's on production and manages the podcast, Ken Schiffman as well, Kristen Martin and Cheryl Knight help get the word out on social media, as do our entire content team, and they do so in our newsletters as well. Rob Hof is our editor-in-chief at siliconangle.com. Thank you all. Appreciate all your help. Remember, all these episodes are available as podcasts wherever you listen. Just search Breaking Analysis Podcast. I publish each week on thecuberesearch.com and siliconangle.com, and you can email me at david.vellante@siliconangle.com, or DM me at dvellante, or comment on my LinkedIn post, and check out ETR.ai, fabulous survey data. They're the best. ETR.ai. This is Dave Vellante for theCUBE Research Insights powered by ETR. Thanks for watching, and we'll see you next time on Breaking Analysis.